Hello and welcome back to the Market Lens. I'm Sam Rozzi, and as usual, I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. Please check out our previous episodes available on YouTube or the Studio 454 video library. Wow, what a week for entertainment. We had March Madness, we also had some Oscar Madness, and I'm hoping I don't get smacked here on set. But in more positive news, the March Madness was great, and we're very happy with the Villanova Wildcats this week, another Final Four.
Yes, we are.
So let's just jump right into the Market Madness and our news or noise segment on the yield curve. The yield curve has had brief flashes of inversion and has flattened very significantly, despite a sell-off at the long end. Cliff, do you think this is news or noise?
I think it's definitely news. We've seen a dichotomy between stocks and bonds as of late. Very wacky action with bonds selling off very hard, up and down the curve with stocks rising, which doesn't happen too often. And I think this strong equity rally we've seen these past 2 weeks is pulling attention away from what the bond market is signaling. Every combination that we've seen, up and down the curve is either flat or inverted, except what the Fed looks at, which I think is important. The curve is more flat, at the short end, and in the middle of the belly of the curve, it's more inverted. We've seen the 10s and the 3s, 5s, and 7s all invert. So I think anytime we've seen over the past 40 years the 10s and 2s, when they've gotten this flat right now, 15 basis points, the curve has ultimately inverted. 6 out of 7 times the curve is inverted. With the 10s and 2s, we've seen a recession.
Yeah, a lot of these talking points in the bond market show some scary things for the future of equity markets here. But you said the yield curve flattened except for what the Fed looks at. Are you referring to the spread between the 18th month future 3-month yield versus the current 3-month yield?
Yes, it's a mouthful, but yes. It's important because it's the steepest it's been in 25 years. They're not seeing the flattening and the inversions because they're looking at something else. And I think that makes a situation where they could potentially hike too much too often.
Okay, what about those do you say, or make you say that this time is different?
They always say that, and they're right, but also wrong. There's are always conditions that are different. The result is often the same, though, when you look at what the curve inverts. I mean, like I said, 6 out of 7 times you get a recession. And when you look at when the yield curve inverts, when the Fed is hiking, it's 6 out of 6.
Yeah.
You weren't in the industry, back in 2006, but Bernanke said the same thing. He said, we're not interpreting the flat yield curve as, indicating a slowdown in growth. And then we went on to have the worst recession in 80 years.
Yeah, one thing that looks different about this cycle is how late the Fed appears to be here. So let's zoom directly in on that. The Fed has never started a hike cycle with inflation already at 8%. What does this mean for the economy?
Well, I think it's tough to say because we haven't often had inflation at 80%. But I think it means a recession happens faster than the typical 12 to 18 months after the 10 and 2s invert. I think the Fed is caught short. We have a very strange cycle that we're coming out of. The pandemic caused the shutdown of the economy, which created all sorts of havoc in terms of ramping back up in inflation. We thought that inflation was going to normalize because you had just basically better comparisons as you started comparing normal markets to more normal markets, and we started to see some of the chip issues in the computer industry work its way out. So we thought inflation was going to take a big step down, but unfortunately we have the situation in Ukraine, which led to this new leg higher and creating shocks in energy and food. I think if you look at what the Fed's looking to do, or at least what the market is thinking the Fed is going to do, 8 hikes at this point, completely out of the question. I think we could be maybe surprised a little bit. In the short term, they might try to hit a 50 bipper or two because you're not going to see the economy slow too badly in the short term. And like I said, they're looking at something completely different than what the rest of the curve is showing. So they may pump the brakes too hard. Previous cycles, when you look at them, they were much more normal, much more spread out, and they had time to, the inflation was at 3-4%. They could spread those rate hikes out, see how things were going. They have a lot less to work with here, and I think that they're going to just have trouble and try to move too quickly.
Yeah, very difficult to predict what happened in Ukraine and Russia, and it caused significant impact to the fuel and the food markets across the world. How long do you think this shock in those areas continue?
I think you need to know what happens, in Ukraine. I think it's difficult to handicap, as you mentioned. The longer it goes, the more likely we're going to see a recession, and the deeper that it will be. There's a roughly 70% correlation between oil prices and the inflation rate, and there's a 60% correlation between food prices and inflation. The challenge there is, obviously the longer you have those two things, at a high rate, the more difficult it's going to be for the Fed to handle, and eventually, going to destroy demand.
Yeah, so we've seen a bit of a strong recovery here in equities, even though it could be a dead cat bounce. Do you think there's a way that we avoid a recession here? Or do you think the economy now, with all these different factors pulling in different directions, is now destined to end up in a recession?
I think we need a significant pullback in oil. The geopolitical premium that we've seen placed on oil, plus shortage expectations given the sanctions in Russia. They need to come off sooner rather than later, and I think that's difficult to see that happening at this point. So I think it might be too late at this point. The cost of capital is rising, like I talked about. The Fed is going to raise rates and maybe a 50 bp here in May. We're already starting to see that effect on the housing market. Look. Higher rates destroy demand. That's what they do, right? They try to normalize the cycle and pull back growth when it gets too hot. The Fed says it can engineer a soft landing. They basically say whatever they have to make the markets happy. They haven't done a very good job of forecasting the economy or creating soft landings, so not overly, expecting that at this point. Look, I think if there was a very quick, permanent end to the issues in Ukraine, maybe we could avoid it. But I think we're, getting close to beyond that point by now. As far as the markets are concerned, I think rate expectations can only go down from here. Like I said, maybe a 50 basis point hike in May. But we got 2% factored in for this year. I think that's very aggressive, and I think more than fully priced in the bond market. I think equities maybe not so much. History suggests equities take some time to adjust to those yield shocks. There's still some talk about how stocks are an inflation hedge. We haven't seen a big impact to margins at this point, but I think we're going to start to see that soon.
Thank you, Cliff, and thank you to everyone who's tuned in. Today we did focus on Russia and Ukraine, but in our previous episode we spent the entire time zooming in. So if you haven't caught up on that, please do. And also, don't forget to register for Connections 2022 at Mohegan Sun in Connecticut, May 18th through 20th, and you can register at connectionsap.com. Thank you, everyone, and we hope this is letting you see 2020. Take care.